It's election week and everything is looking weird in the housing market. On Friday, we got the latest jobs report showing the lowest job growth data for the year at just 12,000 new jobs. And you would think a weaker jobs report would lead mortgage rates to fall, as it would increase the odds of a Fed rate cut. But somehow, mortgage rates ended up even higher, and we'll discuss why that might be here in a minute. And even with mortgage rates back above 7%, housing prices are not falling. In fact, the opposite is happening. Housing inventory is declining, pending contracts are increasing, and even the number of people applying for mortgages is increasing. All of that is the total opposite of what we normally see in November. So everything is weird. We've got a lot to cover. Let's get started. My name is Michael. I'm a real estate agent here in the Dallas area, and every Monday I give you a weekly update covering all of Dallas and Collin counties as well as the national market. We're looking for trends. We're tracking mortgage rates as well as mortgage purchase applications, as that's our best leading indicator to what demand will look like 30 to 90 days from now. We're tracking things like median list price, days on market, how many homes are having price decreases, what's inventory looking like, and if you stick around until the end, it's my favorite part, the top 10 ranked hottest and coolest cities and zip codes in all of Dallas and Collin counties. If this sounds like something you're into, make sure and hit the subscribe button. And if you're looking to buy or sell in the Dallas area, whether it's next week or next year, I'd love to connect. I've helped every one of these yellow dots find their little piece of Texas, and I'd love to help you too. Just call, text, or shoot me an email. All that info is in the description below. Okay, today is November 4th. Let's see what the data is telling us, and if this is an old video, you can click the playlist here, and it'll take you to the latest weekly market update. First up is market news. After several stronger than expected jobs reports leading to higher mortgage rates, the October report is finally giving evidence of a slowing jobs market once again. This report showed that only 12,000 new jobs were added in October, bringing the average monthly gain for the last 12 months to 194,000. This is the lowest monthly job increase since December of 2020. And on top of this, the gains for August were revised down from 159,000 all the way down to just 78,000. If you'll remember, when that number came out, I said there is a very high chance this number is going to get revised way down, and here it is. And then September's numbers also had a small revision down from 254,000 to 223,000. Unemployment remains unchanged at 4.1%, with 7 million people unemployed. A year ago, the jobless rate was 3.8%, with 6.4 million people unemployed. The hardest hit sector was manufacturing, which lost 46,000 jobs. However, BLS attributes this in part to strike activity. Now, I'm not in manufacturing, so I have no idea what kind of strikes are going on, but I did read that Boeing is having a strike, which apparently is a big factor here in last month's manufacturing job loss data. And then another big temporary factor, of course, was the two massive hurricanes that we had. The biggest job gainers were healthcare, adding 52,000 jobs, and government, adding 40,000 jobs. As of now, there's still no evidence that mass layoffs are occurring, but there's definitely a steady slowing of job openings as companies become more and more reluctant to hire new people. And the most important sector to me, as I say every week, is construction. Historically, if we're going to see a job loss recession, there's a good chance it will likely start with mass layoffs, specifically in housing construction. When home builders close up shop and start laying people off, that's usually the first domino to fall in a job loss recession. So the good news is construction is still adding jobs at the moment. They added another 8,000 jobs last month, which gets them to a total of 20,000 jobs per month on average this year. Okay, so if the labor data is obviously getting softer, why did mortgage rates go up instead of down? After all, it seems that everyone is still expecting the Fed to announce another rate cut at next week's meeting. This first chart is the total job openings, and looking at this, it's obviously softening, which is a good thing, but the Fed is not going to be worried about a job loss recession when all that's happening is job openings are trending back down to where they're historically supposed to be. In fact, that's their whole goal. So what they see here is we're finally accomplishing our goal. Not to mention, the economy has been running near 3% GDP for the last 2 quarters. Then here we see jobless claims, which are a hugely important data point when it comes to forecasting a job loss recession. Jobless claims are actually lower today than they've been in over 5 months. So if you think we're going to see a job loss recession, this number would need to be well above 300,000 on the 4-week moving average. And so far, we're heading straight down and are down to 216,000, which historically is very low. So what you see here is the opposite evidence of a job loss recession. Then looking at the unemployment chart, you can see there's nothing scary here at all. We've come down a little from the summer and are simply holding steady here at 4.1%. So while the headline number of only 12,000 new jobs created is certainly lower than expected, when you look beneath the headline, the labor market is still getting softer but not breaking, which is the whole goal of the Fed, which suggests that what they're doing with rates currently and at the pace that they're doing it is working. The facts are we have a 4.1% unemployment rate, we have rapidly falling jobless claims, a growing economy with positive GDP, and a 4% wage growth, which I forgot to mention earlier. Now, the part that is surprising to me is, as far as I can tell, everyone is still expecting the Fed to announce a 0.25% rate cut at next week's meeting. And usually when there's that much certainty around something, the bond market moves ahead of it. So the bond market would have already priced that cut in. But so far, the bond market does not seem to be buying this rate cut, which is why mortgage rates continue to climb higher on Friday. And then, of course, we have an election tomorrow, which does seem to be making everything get a little weird. Now, moving on, we're starting with national housing inventory. This week, we had another decrease of 2,297 less homes for sale in the country. This gets us to just 30% more inventory than we had last year, to a total of 735,718 homes for sale in the country. This same week last year, inventory was only at 566,882 homes, so we're still much better this year. Then, for reference, the all-time inventory bottom of 2022, we only had 240,000 homes for sale. The peak of last year, we had 570,000 homes for sale, and this same week in 2015, we had about 1.179 million homes for sale. Now, looking at new listings, this week we had 60,819 new listings in the U.S. So we even had a small increase this week on a week where we usually have a huge decrease. The new listings data is some of the best news we've had all year for the housing market, because most of the year, you can see the middle line is this year, we were trending well below 2022's numbers. Finally, when rates started to drop a few months ago, we broke out of that and we have held above. We are seeing more and more new listings every week than we have seen in either of the previous 2 years. And somehow we're still seeing growth even in November. So this is good news. Now, looking at pending sales, a few weeks ago, we finally broke out above that 2022 line, and as of now, we have 14.4% more homes under contract than we had last year. So home sales are definitely growing, even with mortgage rates above 7% again. And for context, in both of the previous 2 years, mortgage rates were up around 8%, and actually, they were about 0.6% higher last year than they are today. So it does make sense that we would have more contracts, but 0.6% is not that huge of a difference to see 14.4% more homes under contract. But this week we have 353,766 homes under contract. Then this week, I just quickly wanted to add in, housing prices are holding very steady. And you can see we're obviously well above where we were the previous 2 years. But what's normal at this time of year is to start a seasonal decline where prices will drop usually through January. And then in January, at least the last 2 years, we've seen a spike because rates have been dropping in January. But housing prices are holding very steady, even with high rates, even with election, whatever you want to talk about. But to me, this is surprising. Housing prices have been holding steady. Then the last thing we cover nationally is a percentage of homes having price decreases. Every year it's normal for a third of homes to take a price cut before selling. Looking at the national chart, we actually saw a decrease this week in the number of homes having a price cut. We're down to 39.37%. Last year we got as high as 39.2, which we are very close to right now. The year before, we got as high as 43.2. And as you can see, the last 2 years, it would have been normal to be continuing up all these last few months. Instead, we've just gone straight sideways, and now we're even going a little down. And just so you know, if you want home prices to come down, this number would need to be going up, not down. Okay, moving on to mortgage rates. We started last week at a 7%, and we ended all the way up at a 7.09. And you can just see from this chart, I mean, back here on 9/12, around 9/17, we were at 6.11%. And now we're all the way back up to 7.09. But I truly don't think we're going to get much higher than that. I think we're going to start to come down from now through January. That is my prediction. Then looking at mortgage purchase applications. This week, even with mortgage rates up to 7.09% after just being at 6.1%, we saw a 5% increase in the number of people applying for mortgages. And this gets us to 10% more people applying than we had last year, even with rates going up. So any way you look at it, we are seeing growth in home sales. But I've been saying it all year, and I believe this, there is no reason to believe mortgage demand is going to grow significantly with rates this high, and significantly meaning we're going to get back up here to a normal market, which is well above the last 2 years. We are still at historically low sales by a long shot. So I don't think we get back to the normal sales volume until rates get at or below 6% for a sustained period of time. The evidence I have of that, new construction has been offering below 6%, and they are selling way more homes than the resale market. Okay, moving on to the local market data, starting with the MLS data of Dallas County. We had only 488 homes listed last week. That's 33 less than the previous week. 338 closed, 38 more than last week. Of the homes that sold, 67 were immediate sales, meaning they contracted within the first week. That's 15 more than last week. 291 went under contract, 20 more than last week. In total, there are 1,779 homes either under contract or pending, 69 less than last week. Moving on to Collin County, we had 353 new listings. That's 40 less than last week. 295 closings, 59 more than last week. 56 immediate sales, 24 more than last week. 171 went under contract, 6 more than last week. In total, there are 1,848 homes either under contract or in pending status. That's 11 less than last week. So for the last 2 weeks in both counties, we've seen new listings dropping and sales increasing, both closings as well as new contracts and immediate sales. This is usually the time where things are cooling off all the way through January. Okay, moving on to the Market Action Index. If you've never seen this, it takes into account all this data, puts it into one easy to read graphic with a number. Right now we are a 37, slight seller's advantage. Anything at 30 or below is a buyer's market. Anything above that, we're asking how much of a seller's market are we in. All we use this for to see, are things looking normal or are they looking weird? What should be happening this time of the year? As I've said before, everything should just be cooling off in a nice, slow, and steady way. So looking at Dallas County, we had actually an increase in the median list price. And of course, we don't lean heavily on 1 week data. We're looking for a trend. You can see that the trend from July has been heading down. So it's not that unusual for median list price to go up for a week. Now, if this were to continue up, that would be unusual. But so far, it's just 1 week. Median list price went up. Median price of new listing, as you can see, it's just been straight sideways up and down. Average days on market continues to increase. See, this is something that's normal. Median days on market had a jump a few weeks ago. It's still at 63. Number of homes having a price decrease. This has been pretty flat at 47. Inventory actually had a decline this week. And the Market Action Index, at least that you can see, is trending down. But what we see here is there's nothing significantly unusual. We have little deviations in the 1 week data. At least we have average days on market going up. That's normal. And the Market Action Index, which takes into account all of this data, is trending down, which is normal. Now looking at Collin County, they also had a jump in their median list price, just a small one. Their median price of new listings has just been holding flat. Average days on market as well saw a small increase of 2 days. Median held steady at 63. Number of homes having a price increase jumped up to 4.06%. I don't know how to explain that one. Well, maybe actually there is a lot of new construction in Collin County, and new construction can raise their prices as inventory gets down. So probably that is accounting for just new construction. I don't think there's regular resale homes out there increasing their prices. Their number of homes having price decreases got pretty high around August, September. It's been trending down. It held steady this week. Their inventory has been way more flat than Dallas. And yeah, I guess their inventory has actually been trending down, which is not necessarily unusual for this time of year. It has to trend down at some point. Their Market Action Index has actually just been really sideways. It's not been going down. It's actually higher than it was back in October. So that's a little unusual. But overall, they're at a 36, a slight seller's advantage, nothing to be concerned about here. Now looking at pending sales in Dallas County, you can see this is the black line is this year. We're still significantly above the previous 2 years, but at least we are starting to see a decline down. That's kind of more normal. What was unusual was when everything was trending down, this was going flat and then up. But now maybe we're starting our descent for the year. But still, just significantly more homes pending than either of the last 2 years. That's what you need to know. Home sales are definitely growing. Then looking at Collin County, Collin County has just lost its mind. As you can see from here, things should have been trending down all of this time. That's what happened the last 2 years. Instead, they're really in an uptrend. Somehow, Collin County is in an uptrend in their pending sales. You see that line going up? This is a higher low, and these are higher highs. That's an uptrend. I have no idea how. Well, now we're moving on to the hottest and coolest cities and zip codes in all of Dallas and Collin County. These are ranked using that same Market Action Index number we just talked about. Remember, everything at 30 or below would be a buyer's market. So we're starting with the hottest cities. Okay, the absolute hottest city remains Carrollton, Texas at a 44.69. Then Grand Prairie heats up 2, Coppell heats up 1, Balch Springs heats up 2, Saxe cools off 2, Irving heats up 1, Louisville heats up 2, Richardson cools off 3, Lancaster cools off 1, and Princeton jumps on to replace Allen at the number 10 spot on the hottest cities list. Then we like to zoom into specific zip codes. The absolute hottest zip code is Hutchins 75141, followed by Dallas 75244, Carrollton 75010, Allen 75013, Carrollton 75007, Grand Prairie 75052, Irving 75061, Dallas 75241, and Plano 75093, and Dallas 75287. So those are the hottest zip codes. If you own a home in one of those, you'll be able to sell for top dollar. Now moving on, same thing but the coolest cities and zip codes. Blue Ridge remains the absolute coolest. Sunnyvale cooled off 2, Van Alstyne cooled off 2, Leonard cooled off 2, and Salina cooled off 2. Prosper cooled off 4, Rockwall cools off 2, DeSoto remains. Anna jumps onto the list at number 9, and Royce City jumps on at number 10. And there were 2 cities that got removed from the list. That's why a lot of these cooled off too. Those were Wilmer and Whitewright, and the reason is because I changed the criteria. You have to have at least 25 homes active to be considered for the list, because those markets were just too small in my opinion. So that's why a lot of them cooled off too, because 2 cities at the bottom were removed. But these are the coolest cities, and anything below Salina, these are the buyers markets. Remember, 30 or below. Then looking at the coolest zip codes, the absolute coolest is Wilmer 75172, followed by Blue Ridge 75424, Dallas 75204, Sunnyvale 75182, Van Alstyne 75495, Leonard 75452, Whitewright 75491, Rockwall 75032, Dallas 75219, and Dallas 75233. And anything above Whitewright here, these are the buyers markets, the coolest zip codes. And the absolute coolest is 24.65, but I could not tell you where Wilmer, Texas is. That's it for this week. As always, if you're looking to buy or sell or invest in the Dallas area, whether it's next week or next year, I'd love to connect. Just call, text, or shoot me an email. All that is in the description below. Thank you for watching. I'll see you in the next video.